Hey everyone, this is Yoshi. I run a small investment firm that specializes in REIT investing, and in today's video I'm going to discuss 3 REITs that I sold recently. Now, I haven't had time to properly prepare for this video, so this one is going to be a lot more spontaneous and less edited than usual. Let me know what you think in the comment section below. If you like this style, perhaps I'll film more of these more natural videos because it's quite a bit more time efficient for me. But let's get straight into the first one. So the first REIT we sold not too long ago is called Stag Industrial, ticker symbol STAG. This is one of the most popular industrial REITs in the world. I know that many of you who watch this channel own a position. It has historically typically traded at a discount relative to its close peers like Prologis, First Industrial, and so on. And so many investors would see Stag as a way to invest in high growth industrial properties with a lower valuation and a higher dividend yield. The dividend, which by the way is also paid monthly, and a lot of investors like that. And you know, we like this investment thesis. We held a position in it for many years. We did quite well with it. What we liked a lot about Stag Industrial is that it also had a unique investment approach. It wasn't just following the same strategy as all these other REITs, buying properties in tier 1 markets with rapid growth prospects and simply holding on to them to capture this rent growth. Instead, Stag would commonly target value-add properties and typically will focus on secondary markets. And we like this because for one, secondary markets are a lot less competitive. Cap rates are typically a bit higher. There's less risk of oversupply because most developers like to focus on these tier 1 markets. And we like this value add approach because Stag was able to create a lot of value for shareholders in the process. It would commonly buy properties that had some type of issues that it could fix, like short leases with high risk of vacancy, or perhaps some deferred maintenance. And so it would buy these properties at a discount with high cap rates, and then it would work to resolve issues to create value for shareholders. And you know, if you look at its performance leading up to the pandemic versus some larger peers like Prologis, you'll find that Stag did much better in terms of its total returns. And despite that, it commonly traded at a large discount. So it was a no-brainer for us to invest in Stag Industrial. But even then, we sold it not too long ago because what happened is that some of its close peers, including First Industrial as an example, saw their share prices crash quite significantly. They dropped a lot more than the share price of Stag Industrial. And as a result, the valuation spread between Stag and First Industrial, as an example, compressed significantly to a point where if you adjust for the lower leverage of some of these REITs like First Industrial, there was close to no valuation spread. In some cases, Stag might have been even a bit more expensive to these other industrial REITs that focus on tier 1 markets. And so, which just didn't see the point anymore to invest in Stag Industrial. You know, a very big element of our investment thesis was this discount relative to its peers, but now suddenly this discount didn't exist anymore, or it had become very small. But even then, its close peers like First Industrial actually enjoy better growth prospects. And we think that this is because of 2 key reasons. Firstly, it has less leverage, so it's less impacted by the surge in interest rates. But even more importantly, it's the second reason. REITs like First Industrial today have their lease rates at big discount relative to the market rent levels for their properties. Because what happened in recent years is that market rents grew a lot faster than the lease escalators that they enjoy in their leases. And so lease rates drop deeply below market. And so this is now offering an opportunity for these REITs that focus on tier 1 markets to bump up their rents very significantly as their leases gradually expire. And you know, their average remaining lease terms are not very long. They're typically about 4 years. And so they have a steady flow of lease expiration now in the coming years. They're able to bump up rents by 40, 50, even 60% in some cases as these leases expire. And so they essentially have this bank of growth that they have already secured. They are less, reliant on further growth in market rents because they're already deeply below market. And so we really like this aspect about REITs like First Industrial, and Stag Industrial benefits from this also to some extent, but it's not able to bump up its rents quite as much as its close peers. Typically, Stag has been able to bump up its rents by closer to 20-30% as leases expire. And so we're not bearish on Stag Industrial. On the contrary, we think it's going to keep doing quite well over time, but we just think that its close peers like First Industrial will do better the valuation spread is not large enough for us to favor Stag anymore, and so we sold our position for this reason. I would add here that I've met the management of Stag Industrial quite a few times at different conferences. We've even posted an interview with the CFO on this channel. I hold them in very high regards. I think they've done a phenomenal job, and I'll be very happy to reinvest in Stag someday in the future if the discount relative to its close peers expands to a larger level. Now, before I go into the second REIT that we sold recently, I wanted to remind you that we're offering a 2-week free trial for our REIT newsletter, High Yield Landlord. So if you want to access all my trade alerts in real time, as well as my full portfolio, you can join us for a 2-week free trial. It will be the first link in the description of this video. So the second REIT that we sold not too long ago is called CBL and Associates. Its ticker symbol is CBL. This was probably my biggest investment failure ever in my entire career as a REIT investor. Percentage-wise, we lost something like 80% on our investments, perhaps even slightly more. And I think it's a great example of how, we all suffer losses, and that includes me as well. Overall, I've done quite well over time. I've managed to significantly outperform my sector benchmarks like the Vanguard Real Estate ETF. But even then, I have some setbacks along the way, and CBL is one of them. And it's a pretty long story, but to keep it short, CBL is a mall REIT that specializes in Class B properties, typically in secondary markets. And obviously, when I invested in the company, I knew very well that these were riskier assets. The REIT also had some other issues like relatively high leverage, a high payout ratio. It had to heavily reinvest in its properties. But our thesis was that Class A and Class B malls would survive for the most part, especially as they reinvest in these properties and diversify their uses away from retail to include other things like more services, entertainment, even non-retail uses like medical. So we thought that, Class A and Class B would survive for the most part because, yes, e-commerce, Amazon is growing and it's stealing market share away from malls. However, it's important to consider that the mall market has a very large distribution of different qualities. There is A, there is B, there is C, D, E. And if you look at this distribution, most malls are actually not Class A or Class B. They would fit in these lower categories. And so our thesis was that as the mall market is today oversupplied, many of these Class C, D, E malls would close down over time. This would then lead to traffic consolidation towards the higher quality malls like the B and A's that remain. And in many cases, Class B mall isn't necessarily much inferior in quality compared to a Class A mall. It might be simply that a Class A mall is located in a bigger market, and so it's able to generate much higher sales per square foot than a Class B mall, which is similar but in a smaller market with much smaller demographics surrounding the mall. But it can still be a very viable business. And if you look at the performance of the properties of CBL leading up to the pandemic, their sales per square foot had been very steady over the years. They had not been dropping by any means. On the contrary, they've been rising slightly. CBL was able to also slightly bump up its rent. Its occupancy rate was declining slightly, but holding up more or less. So if you looked, at the fundamentals, the company was doing relatively well. And the final part of our thesis is that we didn't invest in the common equity, we invested in the preferred equity, thinking that this would afford us even greater margin of safety in case the company suffers and, has to cut the common dividend to more heavily reinvest in its properties, which was a real possibility back then. We thought that, the preferred equity still enjoyed good coverage and that, the risk reward was relatively attractive. But then two things went wrong, and one of them is my fault, the other one was out of my control. My mistake was that I underappreciated the amount of capex that will be required, to keep these properties desirable, because I viewed for the most part this capex as discretionary, meaning that they wouldn't have to invest this capex, but they were investing it anyways to grow the value of the properties, to grow their rental income. But in reality, it really wasn't. This was capex that they had to invest, because if they didn't, their tenants would just move away into higher quality malls, or it would lead to declining sales per square foot. And so we should have considered this, capex as mandatory for the REIT, because if they didn't, things would start falling apart. And if you then adjusted the cash flow for this capex, the leverage of the REIT was way higher than what we thought it was. So this was clearly a mistake on our end. But what we didn't control, obviously, is that the pandemic happened, and we invested in the company shortly before the pandemic, and the pandemic was obviously too much for this REIT. It forced it to file for bankruptcy protection in 2020. Eventually, the common equity was wiped out. We were in the preferred equity, so we were not fully wiped out. The preferred equity was converted into common equity in the new company, but, we were still very heavily diluted. And so I ended up selling. Then I held on to this common equity for a while, but eventually I decided to sell it again, not because I'm bearish necessarily on it. I think it's very cheap today. It's likely going to do relatively well as interest rates return to lower levels, especially if the economy holds up in the coming years. But we sold it because I earned some large gains on some other positions, like American Income REIT, Tricon Residential, and a few other REITs. And so I could use some tax losses to compensate for these large gains, to, enjoy some tax mitigation. And so we end up selling CBL Associates for this reason, and also because we identify another opportunity that we slightly prefer for speculative investments. And so that's the second REIT that we sold, an 80% loss. Not very proud of it, but I think it's important to also share failures on this channel so some of you can learn from them. And the main mistake here was underappreciating the impact of capex. So make sure to always study the capex that's required for different REITs, different type of property sectors. It's very important because it can lead you to think that perhaps the leverage is lower than what it really is, or that the dividend is safer than it actually is. So yeah, never overlook capex. Third REIT that we sold not too long ago is a REIT in Singapore called Santech REIT. It's a REIT that we liked a lot leading up to the pandemic. We invested in it because it owned mostly trophy assets in Singapore, which we view as the safe haven of Asia. It's a little bit like Switzerland of Asia in many ways. And so it was nice portfolio diversification for us. It owns mostly trophy assets like the Santech Mall, which is a property I'm very familiar with. I visited many times when visiting Singapore. I think it's a mall that will do really well for decades to come. But unfortunately, the management made many mistakes in my opinion, and the main one is that they started diversifying away from Singapore, and they first bought some properties in Australia, then they bought some more in London as well, and I think that this has and will continue to hurt the market sentiment of the REIT, because before they made these moves, many investors would buy the stock of Santech REIT to gain exposure to trophy assets in Singapore, and it would provide them the portfolio diversification. That was our case. But now these investors don't see this. The thesis isn't the same anymore, because now they're also getting exposure to Australia, to London. It's a more complex investment thesis now, and so yeah, that has hurt the company's market sentiment. I think it will continue to hurt it, and so we end up selling our position at a loss. The REIT is externally managed. The management team has not done a really good job over the years. They have often, sought to grow just for the sake of growth, but not necessarily, putting enough care to avoid dilution. They've also issued a lot of shares, sometimes at discounts to their NAV. So many mistakes. I think this was a case of poor management. We didn't do our due diligence on the shareholder alignment, or we missed some aspects when we invested clearly. So yeah, we end up selling it as a loss. Okay, let's share one more REIT. Before that, can you please click the like button if you enjoy this content? That will help me a lot to keep growing this channel. Thank you very much. And also subscribe. I plan to post some CEO interviews pretty soon on this channel. So I think that's pretty valuable content that you don't want to miss out. The fourth REIT that we sold recently, this is our most recent sale, is Global Medical REIT, ticker symbol GMRE. I mentioned it in my last video, but perhaps I can give you a bit more information on it. I mentioned it in that video that I'm not necessarily bearish on the REIT. It might do relatively well as interest rates now return to lower levels. But it is fair to say that I'm not as bullish as I once was on the REIT, because this is a REIT that focuses on single tenant, net lease, medical properties like medical office buildings. These are properties that typically trade at higher cap rates. It's typically buying properties at roughly an 8% cap rate. And in 2021, 2022, the company was doing really well. It was really on fire because it was able to provide investors both a high dividend yield as well as a rapid growth pace at the same time. And so these two combined together led to very attractive total returns. And this is why we owned it at high yield landlord in our core portfolio. And it's really rare for REITs to be able to do both, provide a high yield plus a rapid growth pace. But this REIT was able to do so because it was buying these higher cap rate properties, let's say 8%. It was using quite a bit of leverage, and interest rates were cheap back then. You know, it could use a 50% LTV with a 4% interest rate, buy a property at an 8% cap rate. That would result in a roughly 12% cash on cash. Deduct some management costs. Let's say you left with 10% cash on cash. So here, even if the REIT traded at a 20-30% premium to its net asset value, it would still offer, and the payout ratio would, let's say, 80-90%. Even then, the dividend yield will still be quite attractive at around 6-7%. But the REIT would trade at a premium to its net asset value, then allowing it to issue more shares, raise some more debt, keep buying more properties at a positive spread. And so that's how it was able to do both, grow at a rapid pace and offer a high dividend yield. But things have changed for the worse for the REIT, unfortunately, because then interest rates surged and its equity value also dropped significantly. It's traded at a discount to its net asset value now for the past few years, or now it has recovered a bit, but it's still, not trading at large enough of a premium to be able to grow accretively by selling shares and buying more properties, or at the very least, the spreads are much smaller than before. And it's also now facing rising interest expense as its debt expires. It has to refinance it at higher interest rates. And so, its growth story has greatly suffered. And, I think it's going to have a really hard time to grow in the coming years. And yes, the equity is now a lot cheaper. You're getting a high yield, but I think the dividend is at high risk of getting cut as well, because now they are facing some rent collection issues. They have some problem tenants like Steward. There might be some more, because remember, this is a higher risk, higher cap rate property sector. Steward is really just one-ish example of that. And so, yeah, you're still getting a high yield, but now they are facing more and more problems. Their growth is going to be limited in the coming years. And ultimately, I think that there are better opportunities in the REIT sector. And that's what we discussed in our last video. We highlighted Sila Realty Trust, which is a new listing that's, in our opinion, superior to Global Medical REIT from nearly every perspective. And so for this reason, we sold this REIT. Okay, so that was 4 REITs that we sold earlier this year. Again, if you like this type of content that's more natural, less edited, let me know in the comment section below, and I'm happy to film more of these for you. Perhaps this will allow me to produce even more content because it requires less time and effort from my end. Otherwise, once more, I plugged it a few times already in this video, but we're still offering a 2-week free trial to our REIT newsletter. We are planning to remove it pretty soon. So if you want to access my full portfolio and all my trade alerts in real time, all our research, our exclusive CEO interviews, now is your last chance to take advantage of this offer. There's a link to it in the description of this video. You won't be charged anything in the first 14 days. You can join, you can read for a week. If you don't like it, you cancel. You won't be charged anything. So it's really no risk for you. It's really just a gift I'm giving you, essentially. Otherwise, also on our Substack, we now have a lot of free research. So if you don't want to sign up for this 2-week free trial, you can just go there, leave your email, sign up for the free newsletter. I think there's some good information on that as well there. But yeah, once more, thank you very much for your interest. Please click the like button, subscribe to the channel, and see you at my next one. Bye-bye.